Very good morning, good afternoon to you all. My name is Bhavesh and I am a wealth specialist at Carrick Wealth. I'm here today with Richard Williams from CFS Group. To give you a brief introduction on Carrick, we were established in October 2014. We are fully regulated in all the jurisdictions that we operate in and have permanent established offices in Cape Town, Durban, Johannesburg, and Harare, as well as Malawi and Mauritius. With regards to Mauritius, it may be worth mentioning that we are only one of two companies in history that have been granted all three international advisory licenses by the Mauritian Financial Services Commission. The Carrick group of companies employs over 200 staff, of which half are in advisory capacity. Since its inception, we have placed just over $500 million under Carrick administration, which I believe is testament to our expertise in the industry. So just to give you a brief, some of the areas we specialize in include the following: education planning, retirement planning, offshore property in UK, Germany, and Portugal, and life cover, which we'll discuss today. So just to give you another introduction on Richard, he originates in Scotland and he has been in the financial services sector since 1987, during which he has lived and traveled all over the world. His focus has primarily been in the wealth management with the then Lloyds Bank offshore banking group based out of Jersey and Dubai. From there, he was with the Scottish Provident International, being based again in Dubai and then in Cape Town. Richard's first visit to Africa was in 1993, and he is fortunate to have a good understanding of the business community as well as the challenges presented throughout the region. More recently, he was a consultant with Provisca, working alongside platform giant Momentum Wealth International. Today, he is the Senior Vice President with the long-established Continental Group, an international financial consultant who help and support a niche group of global partners who specialize in high-value life insurance. Typically, these connections deal with high net worth individuals, business owners, and people with illiquid assets, as well as next generation parties focused on maintaining what they have. He has a wealth of experience, and he is also a visionary who embraces sharing ideas and training with the help of technology, for which he has a very big passion. He lives in Bath, UK, with his wife, Claire, and his two children, Esme and Max. Welcome, Richard.
Bhavesh, thank you so much for that glowing introduction. I really appreciate it. It's lovely to see you today and see lots of people joining this meeting, and I hope you find it interesting. And I'll just say, in addition to that, we are so thrilled to be here with you today and be with our partner, Carrick Wealth, a fantastic company with a great reach across the region, who invest time and money into such professionalism, making events like this really happen. So thank you very much for your warm welcome. You've already introduced me, but I'll just say, Continental is a 25-year-old consultancy who I've known for many years. My focus is purely on the insurance and the high net worth insurance part, which I'm going to talk to you today about. I hope that over the next sort of 45 minutes or so, you will be enlightened with a few things I'll say. I'm going to show you loads of numbers. I've been to Zimbabwe. I think most of you are there. I was just saying to Bhavesh before we came online, my first stay was at the beautiful Meikles Hotel all those years ago. And so I'm familiar with the challenges that you experience when we're not in this dreadful COVID situation. I'm a regular traveler into the Middle East, into Africa, into Europe. I've had a good experience there, as well as having the great privilege of living in Cape Town, which is where the head office is down there. So thank you for your welcome, and let's go on and talk about the things today. And in terms of an introduction, what I would say about life insurance, it's if you're at a dinner party and someone says, "What do you do, Rich?" and you say, I deal with life insurance, it's kind of a big turn off. It's quite boring. And I found when I was in Nigeria just before the lockdown, people just didn't like talking about death. Who does? But no one gets out of this world alive. We're all going there in the end. And I had to move my script very quickly. Why? Because without talking about it, people wouldn't sort of come on board and join us. And So I talked about it as creating a bespoke succession planning solution, and suddenly it got some good interest. And our focus really is to look at the associated numbers that can help people create these succession planning solutions, because we want you to live your life in peace, not in pieces. We've all got life insurance, hopefully, but have we got the right life insurance? Because no one gets out of this world alive. So particularly now, we are seeing some very, very nice business coming through. And I think that's probably because a lot of people are taking time, whether it's because they're in lockdown or have been in lockdown, to review their own mortality and also look around what's going on in the world today. I mean, only this morning, we saw that apparently the deaths from COVID have surpassed 1 million around the world. You probably know someone that's had it. Certainly, we know a lot of people have been affected by it, whether or not they've been infected by it. I know 3 people that have been infected. One of them isn't here anymore, and he was 55, and he's a friend of mine. So we're all in it together. And with that in mind, let's look at the thing that is most valuable to us. And clearly, in this picture, it's our families. It's those people we love and cherish, and the people we go to work every day for. And by the way, this isn't a sales pitch. I'm not an advisor. I'm positioning concept with you. We'll leave that to Bhavesh and his amazing guys in Harare to do. But it's just the concept. And they're the most important things. But it's also, that could be your business, could be your partnership, could be your directorship, whatever. Here's my tribe. Here are the most important people to me. This is what gets me out of bed every day. My wife, Claire, my children, my daughter there in Malawi with at an orphanage there. These are real things. These are real live things. My mother, who's very much still with us, still up in Scotland. My father, bottom right, who's passed away, and my son, who is now at Durham University, locked into his university. He can't even go outside just now. So what I'm going to talk to you today about is how do we protect these people, and specifically focusing on what is called commonly universal life insurance or jumbo life insurance, and it's focused at a specific type of market. And of course, any questions you've got, you can add them to the chat. I know colleagues in the background who are doing sort of a very thankless task. I've got the easy bit. They're looking at your questions as they come through, and we'll have plenty of time for questions later on. So please, if you've got questions, ask them, and we'll get onto those as well. So I've got a few questions. So there are loads of types of life insurance out there. So who is this for? Why should I use it? In other words, you use it. And why is it different? So why is universal life different? Well, there are 4 key areas that we look at when we look at universal life. And as Bhavesh touched on in the introduction there, very, very neatly, this is focused on high net worth individuals, business owners, entrepreneurial types, people with illiquid assets. Now that could be art, wine, cars, watches, you name it. These wealthy people collect this sort of thing. But I'll take you back to a phrase that the best protection policy is the one that pays you the most when you need it the most. If you need money and there's a crisis on and you need to sell a car, it's not going to be worth as much as it will be during a bullish market. So with universal life, you know exactly what you're going to get in the event of your death. And this is very much a living policy as well, and I'll explain why in a little minute. And of course, those people who have got property, they may, for example, have a death in the family and need to sell the property to pay death taxes or inheritance tax. So there are various ways to slot in this type of policy, and as I'll show you, it differs widely from other plans out there. So these are our key people that come to us via our valuable partners such as Carrick Wealth around the world. So those are people that are looking to create a legacy or a succession planning solution, as I alluded to earlier, and typically are the entrepreneurial type, by their very nature, take more risks. So we're wanting to say to them, hang on a sec, you've made it now. You don't need to take those extra risks. It's now all a case of cementing what you have, keeping what you have in place to make sure that your future generations or your business or your staff don't suffer were you to pass away. And you know, similarly to car insurance, it's a legal requirement to get that car on the road, whether you're in Zimbabwe, in Bath, where I am today, in London, in South Africa. You need to have it, but you don't need to have life insurance. It's not a legal requirement. So we're trying to get people's sort of grey matter to really focus on it being a necessity to create that succession plan. Remember, live your life in peace, not in pieces. So wealth preservation, charitable giving, inheritance tax planning. So you don't have to sell the house to pay your inheritance tax bill, leaving your successors without somewhere to live or somewhere to rent out and create an income. Key person protection. I don't like the word key man. Key person protection. So ensuring a director or directors within a business to ensure that if someone dies, then the business doesn't fold, and more importantly, the staff don't suddenly become potentially jobless. Where I live in Bath, most of the office blocks and the shopping centres, they're owned by pension funds. I know that where you are, most of those are owned by individual families. So it's far more vulnerable if someone passes away for that business to have business continuity. So why is it different? Why is universal life different? Now, you will all be familiar with what we call term insurance. I've got term insurance, brilliant, love it, absolutely love it. And why? Because I know that when I die, if I was to die, before my mortgage is paid, then Claire is not going to be thrown out in the streets as the bank reclaims my house. So I've got a lump of insurance that covers my mortgage. So when I have paid my mortgage, it finishes and that's the end of it. Very similar to car insurance. On the 1st of January, you pay your car insurance. If you crash your car, you get a new car, or you get it repaired and you get a hire car, and so and so. And if you crash into someone, then the legal costs cover that. So you're safe. On the 1st of January next year, if you haven't claimed, that money's gone, right? And they just ask for a new premium. And in the UK, I don't know what it's like in Zimbabwe, but they normally ask for more money and you have to go in back as a new client. But it's dead money, but it serves a purpose. And that purpose is to cover a catastrophe and a ridiculous expense. And generally, term insurance is less expensive, as I'll show you. So let's use that as our benchmark to what you might be already familiar with to talk about universal life. So forgive me for putting in there Mauritius. That was where I was able to get the term quotes, but the concept is exactly the same. And more importantly, irrespective of race, color, or creed, we can offer terms for where you guys are right now in Zimbabwe and most of Africa. And we have a slide coming up on availability, but it's pretty much available in over 150 countries. And I'll talk about who's providing the insurance as well. So I'm going to cover all the slots. And don't forget, ask questions if you want me to address anything. I'll happily answer what I can, and what I can't, I love questions that I can't then answer. I'll get back to Bhavesh and he'll filter those out to you. So in this example, $1 million of life cover, which by the way is our minimum. So we go from $1 million to $200 million, big sums, going back to who is it for? High net worth individuals, business owners, people with liquid assets, people with property. But $1 million of life cover for a gentleman age 45 who's a non-smoker, resident in Mauritius, with term, i.e. there's nothing to come back. You'll see as we go down there, the premium is $10,389 a year. That's from a competitor. And I won't say who it is because I'd rather talk about who we are rather than poo-poo the competition. Great policy, but it has its limitations. Those limitations are later down the line. The accumulated value of the policy, if you haven't died, is zero. You get nothing back. So let's look at someone who's reached the ripe old age of 100. I hope I make it. If I don't, it doesn't matter, but I know I'm covered. Then that client will have paid $561,006. What it's done, it served a purpose. So it's meant when he's younger with family and perhaps liabilities, it will pay out $1 million and that's it. Now let's build up on that and look at what would the cost for a universal life policy be. And now that's coming through to you right now. Should be there. There we go. So UL, universal life, an abbreviation I use a lot, is marginally, and it is marginally, more expensive, $10,646 a year. And you can see the build up as we go down there to the point that here, when the client has 100, he's spent $585,000, big sum of money versus 561, again, big sum of money. But this is the bit, and this is why I call this a living policy, because it's living, because if you live, you are building up a pot of $1 million, and I'm using a growth rate there in this case of 5.25%, and it varies by product, and we'll talk about product as well. But the point being, if you don't have universal life, then your policy will be worthless. It's given you what you wanted, which was life cover, but further down the line, what you have with universal life is choices. You have flexibility to draw on that money, but still have the cover, and I'll tell you how that works. But equally, if you get further down the line, you may not need that life cover anymore because your liabilities are covered. Your children have left school. My daughter's 22, she's in Brighton. She's less of a needy of me, and similar to my son who's in Durham, who's 20 in December. But what it has done, it's looked after you when you need it the most. Remember, the best insurance policy is the one that pays out the most when you need it the most. And later down the line, let's get those premiums back with a bit of interest on top. And this is how they build up. So in this particular example, that's coming through now, you can see in the early years, so year 20 on the left-hand side, you've got a growth of, you've got a pot of $188,755. You've paid 212. So the net difference is the real cost. And then as we go further down the line to when someone's 40 or 100, you can see you've got a nice buildup of not only of cash, but you've got a pot that exceeds your total outlay. And there's various ways to cut it. So remember the word bespoke. So if someone says, I only want to pay for once, I only want to pay for 10 years or 15 years or 20 years, that's fine. We can do all of that. And Andrew and Bhavesh and his amazing team down the road from you can help you tailor that. They are very, very well worded on this product and this concept to come and see you and sort that out. Now let's look at someone in Zimbabwe, real life case, real person, $1 million. And in this case, this person wanted two options. Remember, I talked about bespoke. So they wanted to talk about what would be the cost and what would be the benefits for doing $1 million of cover. So taking you from the top down, hopefully you can see my mouse there, $1 million of cover, 20 years funding. So in this case, this is a man who's 35. So he's going to fund it till he's 55 and then forget about it. No more money required. Or he can fund it what's called whole of life. And whole of life assumes that he would be paying premiums in until the age of 100. So a couple of scenarios. So let's look at the left-hand one. So 20 years, I've highlighted in yellow there. So after 20 years, his total capital outlay is $234,000. Here's the thing, there are guarantees in place. And I'll tell you why, because how the growth is derived from, as you'll see in the bottom bit, is derived from tracking 3 indices in this example. And it varies by product, so I'm just giving you an example. And in this example, it's tracking the S&P 500 index, which, trust me, has done 7% since 1958, originally launched as the composite index in 1926. So bearing in mind we're quoting 5.8, we're quoting well within that. So we're going super, super conservative. We don't like risk where protection is concerned. It's investing, it's tracking, I should say, it's not investing, it's tracking the Hang Seng Index and the Euro stocks. So you're getting a bit of a US, biggest economy in the world, bit of Far Eastern, bit of Europe exposure. And every month, what this plan does, it will say, right, how have those 3 indices done for this month? And based on the growth, they will apply 60% of the best, 30% of the second best, and 10% of the third best as growth for that month. So you may be forgiven for saying, but that involves risk. Why would I put stocks and shares into my protection plan? And that would be exactly the right question, which is why versus a unit-linked whole of life policy, which is experiencing down markets as well as up markets, this has the edge. Because in box 3, we have a worst case scenario. So remember, after 20 years, client has put in 234,000. Worst case scenario after 20 years, it's worth $132,000. So what's that? That's about 132,000 of cost for 20 years. What that means is, if those markets all went down every single month, every single year for the next 20 years, it's never going to happen. The client has a safety net. So you don't look at that as a growth, it's a safety net. It's going to catch you. A bit like the trapeze artist, he loses his pride when he falls off the line, but he's okay. So you enjoy the upside of the market. You don't experience any of the downside of the market. And that's important because this is your family, right? Or this is your business. You can't afford to take a risk there. So going to the box above at a growth rate of 5.8%, our 234 of capital outlay, no more money is required to put in. The client still has $1 million of cover, is now grown to $276,000. He's got all his money back with interest, and he never needs to put any more money in again. And he's still got the $1 million of cover. And it's no coincidence, as I mentioned earlier, that at the age of 100, he accumulates a pot of $1 million, again at 5.8, and it will probably be more than that, which he can tap into further down the line. So he may say, when his daughter gets married, he may say, look, I need $20,000 to put towards her wedding, or whatever a wedding costs. I got married in Cape Town. I think my wedding was £1,000, and it was great. I didn't spend loads on my wedding, but a lot of people do. So it morphs into a protection plan that almost has a side bank account. It's absolutely brilliant, and there's nothing else like it in the market today. The upside is capped at 8.3. So if the markets went up 20%, you would capture 8.3. If they went down 20%, you don't experience any of that. So it's a win-win. I touched on availability, and I think it's worth just mentioning that just for a second. And if I may, I'm just going to tell you a quick story about when I first went down to Africa in 1993, and I was in Nairobi, and I had probably one of the most embarrassing experiences in financial services, because I was a wealth manager there, like Bhavesh, like Andrew and Nicola, and I had two clients come to see me at the Serena Hotel in Nairobi, a beautiful couple. She was a local Kenyan, and he was a British expatriate who decided to make his home. First baby on the way, so I was with the Lloyds Bank then, and we decided that let's get the right hierarchy, the order right. So it is cash, protection, investment, very much in that order. Cash, so we had to make sure there's enough cash on the side, protection. And I didn't know at that stage that, to my horror, the insurance companies that we used at Lloyds Bank, who shall remain nameless, by the way, didn't cover local people. I couldn't believe it, because I did all the forms and I got back and I got my hand slapped and they said, oh no, we can only do British expatriates and the Asian market. So that's quite embarrassing. And I felt very awkward about that when I had to go back to them and say, well, I can cover you, the immigrant guy from the UK, but I can't cover your lovely wife. So it did get me thinking, and one of the first things I looked at when I came on board with Continental, I said, well, I need to know how it treats people around the world. So very important in terms of the availability. It's based purely on one thing: where you live. Doesn't matter. It doesn't matter if you're a local, or if you're an expat living there. It doesn't matter. It's where you live, and I think that's a brilliant feature. A broker the other day said, "Can I get cover in Benin?" I shamefully said, I don't even know where Benin is. I know it's in Africa, but I didn't know whereabouts in Benin was. So I looked it up on the map, looked at it in the country guide. Yeah, sure, we can do it. Angola, yes. Zimbabwe, yes. So as many of the Western companies have moved out of the market, here we are very much moving in. So we're teaming up with key partners, not everyone, key partners such as Carrick Wealth, to make these services available. Before I will come back to sort of the availability later on, but I want to just talk about how do the premiums work, what actually happens to your money. And I'm going to go into my car insurance example again. So when I pay my car insurance, I have my premium, and it pays for the cost of insurance down here on the right hand side. So premiums top left going to the glass on the bottom right, forget the rest of it. So it's a legal requirement to turn the key and move the car. And if you don't, you're in big trouble. And yet, as we mentioned earlier, it's not a requirement to have life cover. So what happens here is the premiums come in from the left-hand side from a client's bank account into what's called the account value, and that's the accumulating bucket. I'm going to refer that to as a bucket. Keep it belt and braces and simple. It's a bucket of money that is growing in line with whatever plan you've gone with. So I gave you an example where it was accessing the S&P 500, the Hang Seng and Euro stocks on a 60, 30, 10 split. So that's coming in from the sides. That's called profit earnings. So remember this, as long as there is enough money in the bucket to pay for the drip cost of insurance, the client has flexibility. If you don't pay your car insurance, you're not covered. If you don't pay your term insurance, you're not covered. And it doesn't automatically mean it will be reinstated for you. You look at now the environment we're in with COVID-19. The world is going to be changing in the world of insurance very, very quickly. We don't know what it's going to look like right now. We're in the midst of it. It's not over, is it? But it will undoubtedly have an effect in the long term on the way insurance companies treat their clients, which is, I think that's why we're getting more business than we would normally envisage, even though we can do it remotely as here, talking to with our partners around the world. So that's a key diagram to remember. Safety is really important. You know, I'm sure that in your world, you'll see a lot of these things that might happen. Invest in this, it will be great. And I've seen loads of things, and I get boiler rooms calling me about this amazing investment. So first thing, why would you even think of doing anything that involves risk for your family just because it sounds kind of good? And you'd be very right to think like that. So we want to ensure the reliable transition of your money to the insurance company. So anything you decide to proceed with further down the line, once you've spoken to the advisors at Carrick, the money does not go to Carrick. It does not go to Continental. It only goes between you and the insurance company. And what does that do? That gives you surety. It cuts out risk. Not that there would be risk, but it just cuts it out, doesn't it? Because it means that that's the right way to movement. So what I haven't spoken about is the quality of the companies we're using. If I guarantee you a $10 million policy, you're only as good as Richard Williams, and I haven't got $10 million, so it'd be a bad bet. However, the partners we use are very selected. So typically we use Manulife and Sun Life Financial, and they cover different parts of the world. So for example, the default for Zimbabwe is Sun Life, because Manulife don't have terms there, as is the case with a lot of companies, but Sun Life we can work there. So first-class insurance carriers, large sums assured, minimum guarantee cash values accumulating, life cover, and premium financing solutions tailored to your needs. I like independent ratings. I may think I'm a wonderful guy. It's irrelevant. It's what an official body think. And in this case, if we look at the S&P rating, Standard & Poor's, very, very highly respected independent rating authority. They both rate both companies as very, very strong, and you can look them up. And they're very, very big. And the reason we work with Carrick in this way is because the consultancy I work with, we are one of about a dozen that carry these companies, and then we work with our partners around the region. So very strong companies. Let's also look at safe transition. And by that, what I mean is safe transition if a client, perhaps you or your friend, dies. If it's held in a will is quite easy to contest. I know a family in Scotland, my native Scotland, which you can't tell by my accent, where the husband died and he hadn't made a will. Under Scottish law, if that's the case, you cannot touch any of your assets for 1 year and 1 day in case someone else contests it. For this guy and his family, he was a teacher at a very big boarding school in Scotland. His wife, not only has his wife lost income, she had to move house. She had to move out of the schoolhouse. She had 2 children at that school paying full fees. A disaster. And everyone was saying, what a shame for this guy dying. Actually, it was really bad planning, if you're ruthless about it. And so we go a step further here. So every case that comes in is not held in the name of the client. It's held in the name of a trust. Why? Because a trust is you are entrusting the trust to deliver the assets on your death to your loved ones or to your business if you're doing a key person plan, for example. So this is the order. So black is alive and red is death. So the premium is going in to the trust company, which is all in-house, all part of the insurance company. It's a paper exercise. And that is then paying in-house the premiums to the insurance company. Very, very simple. And then on death, the insurance company pays the trust company the $1 million or whatever it may be. The biggest case we've done this year is $75 million, by the way. So we've got that capacity. And then within that trust, you have two things: a primary set of beneficiaries and a secondary set of beneficiaries. So for me, my primary would be Claire, my wife, and my secondary would be my daughter Esme, my son Matt, and probably a bit of charitable stuff going on there as well. And so a trust cannot be contested. A trust sits outside of your estate. So for tax planning, it's very, very useful. Again, always takes some professional tax advice because it changes by jurisdiction, but that's the concept behind that. So it means that can be safely transferred upon someone's death. Because unless you know when you're going to die, why would you get a term insurance? There was a very good saying I heard the other day: if you didn't know when you were born, how old would you feel? So I feel younger than 53, but statistically I'll live till I'm 77. So why would I do a term policy? I have a whole of life policy as well for me, so I know that they'll pay out. And then when I don't need the money, I just sell it and get my money back. That's what I've got. So let's talk now about moving on from the concept. If you like what you see and that all makes sense to you, what is needed in terms of underwriting. So there are two types of underwriting. One is financial and two is medical. So the financial underwriting slide is here. So on the left, you have an indication of the multiple levels of cover that the insurance company will provide. So with the greatest respect to Betty, who serves tea in the tea room, she asked for $10 million, she's not going to get it. This is for high net worth individuals. So typically, certainly Manulife, they look at high net worth individuals, someone holding $10 million of assets. That can be shares, could be property, could be cash, could be other assets. But anyway, that would all come out in the financial underwriting. But equally, Sun Life are a bit more forgiving in terms of that amount. So it's very, very flexible. But there's two things here. One is the insurance company don't want to have a plan that someone can't afford. And secondly, they want to be able to tailor it to meet their requirements. And as we go down there, these are the sort of, I won't read them one by one. That will be for Bhavesh and colleagues to do with you if you decide to look for more details. But they will ask you for quite a lot of information. So be prepared for that, because it will be essentially we're lining up the background of the client so that the insurance company can make an informed decision as to, yes, we can offer cover, or no, we're not going to. And it's very rare that they say no, but that's because we've got a good team in Dubai, our private clients team who tee everything up right. And if you were to provide a load of information to Carrick and it was insufficient or something was missing, we'll just come back and ask for more. So for example, you might be asked about your travel, and you could say, I go on holiday 3 times a year. Okay, so where do you go? Are you lying on a beach in Nice, or are you sort of bird watching in Syria? That's kind of a different from a risk perspective. So it will be a case of gathering a lot of information about A, your lifestyle, and B, the background in terms of your financial history. And of course, where medicals are concerned, yes, that is required as well. So the medical is very, very straightforward. It's a prod and a poke in terms of a general examination. There's 4 things to bear in mind. One is a blood profiling, so 100 tests take place behind the scenes, as you'd imagine. A urinalysis, so various tests there on someone's pee. Resting and stress ECG. ECG is echocardiogram, and that's to make sure that your heart works properly. And we've had cases where we've identified problems that the client didn't know anything about because of that, and still done the cover, by the way. So it's quite a good sort of health check in any case. And that's all paid for by the company. And then there's a chest X-ray. So once all that information has been accumulated together with the financial underwriting, we go to the right-hand side, which says post-underwriting, which the insurance company will come and say, hey, we're happy to work with this person. That will be great. And secondly, then once they've done that, they will give the bank details for a transfer to be made. That is typically made from an offshore bank account. And once that money is received, the client is what we call on risk. He's covered. He's got life cover in place. He or she will get a policy schedule, a policy document, as well as a copy of that being lodged with the trust company. So everyone knows what everything is. And that's the time you just chuck it in the drawer and you forget about it. But you make sure that others know where it is in case anything happens. So you are on risk. Going back to my slides, what if you can afford it, and now hopefully I showed you the numbers, why would you do term when you can do universal life and get your money back with interest on top? I'm just asking that question because it means that you are going to get something back as well, and it kind of morphs into an investment in dollars. It's dollars only, by the way, US dollars only. So what next? What happens next? If you like what you see so far, and I'm delighted to see, by the way, no one has dropped off this call. I may be tempting fate, but no one has dropped off as yet. It's a case of arranging to see Bhavesh, Andrew, Nicola, colleagues, and the sort of information I supply for them. So I'm really focused on service. I like technology. I really enjoy and embrace it. I feel when someone sends me an email, the clock is ticking for me to get a response back, and I service them behind the scenes. So they will sit with you. They'll look at your current situation, which we obviously don't know at this stage, and they will say, look, on the basis of above, we would recommend you get $2.2 million or $1 million or whatever it may be. And then they will come to me or colleagues within our private client team and ask for the following information on the left. It's like a menu of requirements in order to get a bespoke quote for you. Your name, date of birth, male or female, where do you live, do you smoke? Please don't smoke. It's not worth it, and I'll tell you, it's financially not worth it. I mean, it puts your premiums up. If you're not smoking, please don't start. It always amazes me how many of these vaping, by the way, counts as smoking. And here there are vaping starter kits for teenagers. It's just madness. That's another subject. The minimum level of cover is required is $1 million. And it's always useful to know of any pre-existing conditions. And I'd say that sort of cautiously because it's always a bit sensitive, isn't it? You know, but things like you could be an asthmatic or you might be a diabetic. Doesn't mean you're not going to get covered because most of these things can be treated with the right sort of drugs. And they will be the sort of things that will come out when we ask for, say, an attending physician statement to sort of talk about you. But from there, you'll then get a long quote. You know, it could be 15 pages, but I tend to summarize everything onto one page with the key numbers that I showed you in the earlier diagram with the yellow bars. And it's really to get you to the point to say, yes, I can afford that. Yes, I actually need that. Let's do it. And on that basis, then a medical is booked. The initial application process is all done, and don't worry about that. You'll be guided through that by the colleagues at Carrick Wealth, and they will look after everything for you brilliantly in the background. So I've rambled on for 41 minutes, and I said 45, so I'm kind of within my slot there. So from my side, I think now is it's an incredible time. I've been in industry 33 years. I've lived all over the world. I've never known a time like this where we are all in it together and there are no bombs being dropped. We are all conscious of our mortality and what's going on. And I think more ever than now, it's a time to just say, hey, 1 million people have died around the world. This virus, for example, is indiscriminative. It doesn't pick on anyone in particular. It's a time to reflect and think about what will happen if I'm not around or if my wife isn't around, for example. So with that, I would say take a look at it, have a chat with the guys at Carrick. As I said, they're very, very familiar. We've done a number of training issues in the background. They have the best team in the background, whether it's marketing, whether it's administration support, whether it's in their sales, their individual management team, their directors. They're a real class act and the real gold standard. So we love working with them and we have interactions with them every day. You're in very good hands there. And equally, it may be this isn't for you, but other things are. So, you know, I don't care about that. I just want to be in a position to say, look, this is what we can bring to the table. If you like what you see, book an appointment with them and see what they can bring to you, because you might be pleasantly surprised. And if you don't, you might also be vulnerable. So with that, I would thank you for your time and your patience. Everyone who started is still on the call, which is wonderful. I believe a recording is being made of this, and I will hand back to Bhavesh, who very kindly introduced me to you earlier, but I hope you found this useful and interesting, and I wish you well and hope you stay safe out there. Bhavesh, back to you, my friend.
Great, thank you very much, Richard. Before you go, we just got a few questions that have been asked. So the first question, if we go ahead with life cover, are the medicals covered?
Yes. Do you mean by that, are the cost of the medicals covered?
Yes, I think that's what the question was. Yeah. So are the costs
Yes,
of the medical covered?
Yes.
All right, great. There's another question here. Are there any specific medical conditions that you do not cover?
Goodness, well, there would be a number out there. I mean, certainly HIV would be an issue, as you would imagine. There'll be, I mean, the word cancer, for example, is a very big word. It's a very small word actually, but it's a very big game out there. So I think those are areas where, if you go back to the menu I mentioned to you earlier, I think it's important at the beginning to advise of any pre-existing conditions. So for example, if someone has recovered from a heart attack, if someone's recovering from bowel cancer or something like that, just let us know at the early stage. For two reasons, because we'll be able to say very, very convincingly from the get-go, I think we'll struggle here. So there are a few conditions that are excluded, but once someone is on cover, you know, if they suddenly later down the line develop cancer and die, then they would be covered. So there's a whole host of anomalies and lists, but by and large, I think the advice I would give you at this stage, Bhavesh, is to advise of any known pre-existing conditions.
All right. There's another one that's come in here. How long does it take to apply and be covered? So I'm sure after the quotations have been signed, all that paperwork, how long will it take for them to be covered?
Well, that's a great question. And there's a few parties involved here, including us and you, and of course the clients. So with the wind in our sails, I think probably you'll be looking, you know, from the meeting to the quote, to the acceptance, to the medical. We have a published set of service standards, which I'll send over to you, by the way, after this call, and you can distribute it to your contacts. I think with the wind in your sails, 6 to 8 weeks, but equally, we've had instances where some clients have not responded to emails or haven't been able to go back for the medical. So we are, you know, it's a tri-party cooperation. Let's put it that way. If everyone cooperates, we can do it quickly. If one doesn't, you're only as good as your slowest horse. I've had a case in Kenya that went on the other day, and it had been going on for a year. Why? Because the client just wasn't playing ball. He said, no, I want to do this. And we actually have to say, this is going to run out. So we are closing this file. And immediately he came back and said, I've got to do it. I've got to do it. And we got the case on straight away. So if you like what you see, then move quick and we can be as quick as you want.
All right. Another question just came in here. Is it possible to borrow money against my policy?
Yes, it is. It is. There are two types of lending. Let me just explain those. One, for single premiums, some of the banks will actually lend for those, and we don't encourage that. But for the policy, if someone is wanting to borrow money, yes, they can borrow for it. I would call it one of those ICE events, in case of emergency. I wouldn't advise it, I wouldn't encourage it, but yes. So the quote will show you the cost of the lending, which isn't particularly high because interest rates are very low right now. But you remember I showed you the bucket. Clients further down the line are able to borrow against that. And similarly, they can take that policy to a bank and say, look, you've asked me for extra collateral. They can temporarily assign that policy to a bank if they want to borrow a property to enhance their business with a new property or something like that. So yes, most definitely.
All right. Another one that's come in: are acts of God covered?
Well, there's many acts of God out there, but by and large, yes, they would be covered. If you can be more specific, I can try and get some feedback on you for that.
All right, perfect. Yeah,
if someone was struck by lightning, they're dead. Yes, they would be covered. And similarly, acts of war, acts of terrorism, yes, they're covered. And it happens, you know. I mean, I missed the Westgate by 2 days. I was sat in the seat where the American died at the Dusit Hotel in Nairobi 2 days prior. He was a friend of mine, and I actually had breakfast with a colleague of his at that seat, where he sadly was killed in a terrorist attack, and that would be covered as well. So very good question.
All right. The last one that's come in: how long after death does it take for my family to receive the money?
Again, that will be on the service agreement that I'll send through to you, but by and large, you're looking sort of 30 days max. I mean, as long as there's not any incriminating circumstances, or it's not sort of sat with the police or something like that because it was a bit dodgy, which might pan out slightly longer. But yeah, and someone dies of a heart attack in their sleep, it's going to be 30 days, and it's just a case of gathering the information, submitting it with our assistance to the insurance company, and they pay out. And I think that's really important as well, because just as the premiums are paid directly to the insurance company, the payout from the insurance company doesn't come anywhere near us or with Carrick. You know, we are mediating here. You are mediating here between the client and the insurance company to find the best contract for them, so they can pay them direct and be paid back direct in the event of someone's passing away, because we're all going there, right?
All right. Sorry, 2 more questions have just come in. At what stage can you stop making payments and start getting payouts?
So with the Sun Life one I showed you, if you took a payout during the first 15 years, you have early surrender penalties. So that's why I would say look at this in its latter stages as an investment plan, but certainly in the early stages, you shouldn't be looking to touch it. But in terms of the flexibility, I'm not paying in premiums. Remember the bucket I showed you with the drip, drip, drip to the glass at the bottom right? As long as there is enough money accumulating in that bucket to pay that drip of cost of insurance, then the client can have flexibility. Because just as now, you may say, look, I just can't afford the premium this year because of COVID, my income's down. That's fine. The bucket will pay it because it's accumulated in value by linking to various indices. Yeah, that's a great question. You don't get flexibility with other plans.
All right. Then one more is coming. So can you please kindly repeat the minimum net worth for a person to get onto this policy?
Yeah, another very, very good question. The plan I showed you was from a company called Manulife, and their minimum in terms of a high net worth individual was $5 million. However, significantly less than that with Sun Life. So I think they would certainly entertain someone sort of $1.5–2 million of net worth. So they will literally, when in the application process, they'll look down your assets, any liabilities, which spits out a net worth number, and we can work with that, and we can help you with that as well. So again, it is for the high net worth individuals. This isn't for the sort of retail man in the street per se. Great questions. Did you line all those questions up? Yeah, we're very good.
Yeah, very informative. Yeah, I think that's all the questions for now. Well, Richard, thank you very much for your time today and for sharing all your information and knowledge with us. We really appreciate it. For everyone that's still on the webinar, we'll be sending out an email through to you shortly or in the next couple of hours just to thank you for joining and yeah, see if we can arrange a meeting with you directly.
Thank you very much. Take care, everyone.
Have a good day, everyone. And yeah, we look forward to hearing back from you.